Welcome to Yahoo Finance's special coverage of the April jobs report. I'm Brad Smith alongside Madison Mills, and guess what? We are just moments away from that payrolls print here for the month of April here as we're just waiting for that data to cross and taking a look at the futures here this morning. Seeing some fractional gains. We'll see exactly where this report ultimately moves the dial here for investors.
Yeah, it's a really interesting one to watch. As a reminder for our audience, the survey for this payrolls print came out the week of those tariff announcements a month ago here. So unclear whether or not this is going to be the print where we see that impact taking place. Bank of America's Michael Hartnett out with a note this morning saying, yes, the jobs report data is going to be the most important thing for the Fed to watch, but not this month's job data, because this is not the one where we will necessarily see the full impact of those tariff policies.
Yeah, you think about what we're looking at in the CME Fed Watch tool as of right now. Going out through the rest of the year, it looks like the markets are leaning into this pricing in of 100 basis points of cuts from now until December and finally at that December meeting. And so the question is, what type of trend would the Fed need to see to take that type of aggressive action ultimately, as we come into the year, just looking at one or two cuts on the back half of this year? That scenario has changed everything from tariffs to some of the more aggressive cuts in employment here on the government side has really caught the attention of economists and investors alike.
Yeah, the market now pricing in more rate cuts than even Fed members themselves have said are coming. Chris Waller with the Fed saying it would be the June figures in terms of jobs data showing the tariff impact here. It's interesting to also note that we are going to be giving a keen look at average hours over the course of this month, because you do tend to see hours tick down before you see actual layoffs ticking down. So that's something I'm going to be monitoring in just a couple seconds here when that April's report crosses the wire here, as we are expecting those numbers coming in right now. So 177,000 jobs over the course of the month added. That is above the survey data showing 138,000 jobs added here. Taking a look at the unemployment rate, that is bang in line. The expectation, 4.2% coming in just in line with that at 4.2%. Unemployment, the underemployment rate here coming in at 7.8%, just a tick below the prior month. So that's interesting to monitor here. Average hourly earnings month over month at 0.2%. That's just below the survey of 0.3%. Average hourly earnings year over year coming in also just a tick below the survey of 3.9%. That number coming in at 3.8% here. Really interesting. I just want to reiterate that headline number. The actual number, a huge beat, coming in at 177,000. The estimate there, 138,000. And interesting when you look kind of across the data here, the only thing that I don't even want to say surprise to the downside, because it's such a small move to the downside, but that average hourly earnings month over month and year over year just a tick below the survey data.
Yeah, just a little bit more color on the different sectors here within the data. Employment continued to trend up in healthcare, transportation and warehousing, and financial activities and social assistance. Federal government employment did decline here. And I did a quick Command F, Control F for you Mac, or Command F for you Mac users out there, but for the Microsoft users, it is Control F. But federal government employment declining here, that kind of coming in line with what we had seen in some of the Challenger Gray and Christmas data earlier this week, where there was more of a read-through trying to annex or trying to get a sense of how much of the Department of Government Efficiency position eliminations were really going to start to show up in some of this data here. We had seen that earlier in the Challenger Gray and Christmas layoff data this week, and then additionally now flowing into this employment situation report as well. And so looking through the federal government employment, that declined by 9,000 in April. It's down by 26,000 since January, and employees on paid leave or receiving ongoing severance pay are counted as well as employed in the establishment survey, we should note. For more color on this report, let's bring in Steve Sosnick, who's the Interactive Brokers Chief Strategist, and Veronica Clark, who's the City Economist. Great to have you both here with us. Steve, I'm just going to turn to my left here because you're in studio here with us. You were having bells and whistles go off on your laptop as this data crossed this morning. I want to get your initial read.
Well, the initial read is another set of sigh of relief here for the markets. I mean, you've got more jobs than expected, although the revision sort of offset that, the revision lower. So it's kind of a push there, but enough. The unemployment rate stayed stable. Monthly hourly earnings, average hourly earnings went down a little bit, so that sort of helps the inflation picture. Bottom line from a market's point of view is the stock market is looking right now for any excuse to rally, and it doesn't really matter why. And they got one today. You could just feel it. The momentum is so strong. And remember, when you're trading off of momentum, you're basically saying, I only care about price action. I don't care about fundamentals. And so as long as the fundamentals aren't bad enough to upset the party, you get the kind of relief rally that we're seeing.
So Veronica, how big can the party be off of this report, given the fact that it doesn't necessarily take in the totality of potential impact from tariff policy?
Yeah, I think we should maybe be a little bit cautious with this one because, yes, this survey is taken earlier in the month in April. So it's really not going to reflect any hiring or firing decisions that are made after that April 2nd announcement. And as we're getting into May, I think what we know initially is that businesses are going to pull back on hiring. And we have started to see signs of that. We've had continuing jobless claims that are rising. That's a really good signal for, are people getting hired if they do get laid off? We've had Indeed.com job postings that are falling more sharply in the latter half of April. So that weak hiring this time of year, this is usually when you do hire a lot of people. You get new students, graduating school and entering the labor force. So we would expect that some of that summer data is going to start to look softer.
Does this to you seem like a report that sets up any type of trend that the Fed would need to really signal to the market that's expecting 100 basis points of cuts between now and the end of the year, that the beginning of those cuts are even in sight right now?
Yeah, I mean, there is so much uncertainty. Obviously, we have a Fed meeting next week. I don't think they'll really take anything off the table, but they're maybe going to sound like they have, and indicating that they can be patient. They want to see how the hard data are evolving. Obviously, we have seen survey data that have been much weaker, but we haven't seen that yet in the hard data. But I would worry that things could just change very quickly. If we do start to see a more rapid increase in the unemployment rate, that's what got them to cut 50 in September. We had in 1 month a 0.2 percentage point increase in unemployment. If we start to see that, I think that they would be reactive, and that may be by the June meeting.
Yeah.
So sorry, Steve, traders are still expecting nearly 4 Fed rate cuts over the course of this year. Are they missing something in this jobs report?
I'm not going to say that the traders are missing something in this jobs report, but it's important to keep something in perspective. So the Fed is widely expected to do nothing at this next meeting except, to give another set of speeches and try to set some groundwork. So that means there's 5 meetings after the May meeting. That means the market's expecting basically a rate cut at 4 out of 5 meeteds. So you have,
means we're in a recession,
so
right?
That and bingo. That's really the only explanation that I could have. I mean, especially because Powell has said more or less that he's going to be reluctant to cut rates without knowing what's going on with the tariffs. So at this point, the 90-day period ends after the June meeting. So it's early July is when the 90-day hold off for whatever. I'm using the wrong words, but so. So is he going to do anything in June without knowing the full effect of the tariffs? Probably not. Also, I do have to think that there's going to be a little bit of intransigence from him, sort of saying, you can't bully me, And so I think it's one of these situations where be very careful what you wish for. If you're wishing for 4 rate cuts before the end of the year, it's probably not a very stock-friendly environment because it means that we're probably looking at some sort of recession. And we don't really know whether the Fed is going to lean in toward labor, which would have to get markedly worse for them to lean in, or start to be nervous about price inflation from tariffs, which kind of keeps them on the sidelines. So there's a lot of moving parts here. I think that the Fed funds futures might be a little bit ahead of themselves.
And so that's what I was about to ask you, actually. For the investors at home that are, just firing up their portfolios, taking a look at their watch list and trying to figure out, okay, what does this data even mean for my trading thesis right now? What's the trade that you initiate off of a report like this?
I think it's just more of a stay the course type of report. I don't think there's enough in here. To Veronica's point, there was not a lot of new stuff, and it doesn't really encompass the stuff that we really want to learn. I mean, I'm going to call this the latest in sort of the series of market mulligans. I mean, when we think about earnings, could you imagine an earnings season where companies routinely said, we don't know what our guidance is going to be, and stocks just sort of yawn and take it higher? In any other quarter, that's like grounds for a double-digit haircut, but they're getting away with it. So to some extent, why not get away with it on the jobs numbers too? Market's in a very charitable mood that way.
And to that point, Veronica, I wonder how charitable the economy is going to be off the back of the potential impacts of these tariff policies that we haven't fully seen yet. Where does your recession call stand right now?
Yeah, we're honestly kind of 50-50 on it. Part of the issue though is that we might just get a lot of weird data, and we started to see this in Q1 GDP, where we had really strong imports that weighed on growth. But then of course the details looked a lot stronger. We had stronger consumption, business investment, but a lot of that strong consumption and business investment looks like it was people front loading activity before tariffs, and you might get some of that continuing in April, May. So some of the hard activity data might look stronger for a while, but eventually if the tariffs last, then we are dealing with shortages of goods. We're dealing with layoffs, likely in sectors like transportation or manufacturing. You're dealing with more uncertainty, which would cause people to pull back spending at some point. And you might see that labor market weakness showing up before you see that activity data turning. But for the Fed, that's what matters.
What should the consumer read on this employment data and this employment situation be, Veronica, knowing that some of the consumer confidence and the sentiment readings are routinely tied back to what people's employment prospects look like?
Right. Yeah, I mean, this is strong data, of course. This still does look on the surface like a healthy labor market. We have seen, of course, the unemployment rate that has very gradually increased over the last 2 years. It's more moved sideways in the last 6 or 8 months or so. But that increase in unemployment has already come from businesses not hiring. Hiring rates have been very low, and we saw that in the JOLTS data earlier this week. So I would maybe see there's still a reluctancy of businesses to hire, and that could only get worse. That maybe there is a bit more precautionary savings that consumers would be doing.
All right, Veronica, thank you so much, and thanks to our Steve Sosnick for joining us in studio as well. Appreciate you both.
Thank you.
Let's send it over now to our own Jared Blickery for a look at what is moving off the back of that jobs print. Hey, Jared.
Thank you, Maddie. Let's focus on the indices. In fact, the index futures here, just about all the majors were up about 1%. They're backing off those highs a little bit, but the Russell 2000 is catching my eye. It is up 1.5%. And you can see, let me put a 2-day chart on here. You can see it was already up to the highs of yesterday, and then it backed off of a little bit overnight, and now it is right back up there. So the Russell 2000 is what I'm watching here. I'm going to come back to that in a second, and let me show you a bigger term, a longer term picture of what's happening this year in the S&P 500. This is a year-to-date chart, and what I want to show is right here we have just passed this prior breakdown level, and now we are accepting within this price memory area where we had a lot of activity. The dippers may want to get out at break even, but that's why we need these bullish catalysts, and today might be one, it might not be one, in order to get beyond the hump. And the hump is all this price action in here. So this is the beginning stage of a recovery right now. The Russell 2000 is at a more critical level because it is right up against that level. It hasn't crossed it just yet. Might be in the futures, but we'll have to see what happens into the close today. That's going to be the most important. I want to get a quick take on the bond market and show you what the 2-year futures are doing. Those took a bit of a dip on the report. That means interest rates are moving upside to the upside. That's because prices of bonds and the rates move at opposite to each other. Then here's a 10-year T-note yield. This is actually the futures. So the yield is up. This price is down. And I've also been tracking some of the things that have been going on in the commodities market, which have been instructive. Gold futures pretty close to record highs here. This is an intraday chart. Not seeing too much movement off of the report right now, but if I show you a 2-day chart, you can see it has just been trending higher here, and the year-to-date really tells a story, up almost 23%. So just camping out, very comfortable by those highs. Meanwhile, crude oil has taken a dip. This is a year-to-date chart. It actually hit the second lowest level in 4 years yesterday, and so crude oil is on my radar as a barometer of the health of the global economy, global demand, all that good stuff. I do like to track Bitcoin as well around some of these announcements, so I'll go back to the intraday. Not seeing a whole lot of movement there, but 96,000 is a nice rally off of those 74,000 lows that we saw just a bit ago. Here's the year-to-date reference for Bitcoin lovers and crypto enthusiasts right there. And then finally in the futures, I will show you what's going on in copper if I have a second, because copper as another proxy besides crude oil for global demand barometer, that has been rising along with precious metals in fits and starts. So here's copper right now. We can see it's up 1.72% for the day. Hasn't really moved much off the report. And here's the year-to-date look. You can see it's right in the middle of this price action area. This is important because the direction of Dr. Copper could point the way to a global recovery, more reflective than leading. So let's take a look at the sector action and the background color just for reference. That's what happened yesterday. So we saw a strong day for tech, and I'm just going to circle that here. It was up 1.47% yesterday. This morning, it is up 72 basis points. That's 0.7%. But in the pole position, we have financials, which were basically flat yesterday, just a little bit to the downside. They're up 1.3% today. Real estate is in the second position this morning in the early action. That's up 1%. Consumer discretionary up 1%. Healthcare up almost 1 as well. And we better take a look at the NASDAQ 100 because we have got those earnings rolling in, and we saw huge reactions yesterday from Microsoft. We saw a big reaction from Amazon. We're seeing a little bit of one today, and Meta in particular. It was Meta that was catching my eye yesterday along with Microsoft. So we're seeing a lot of positive price action. Guess what? Not in Apple. Apple is down 3%, down 14.82% year to date. This is a year to date chart. Kind of looks like the S&P 500, in as much as Apple is also a bellwether for stocks. I do want to see a little bit of a pickup there, but if we see a little bit of weakness here after that pronounced strength that we saw over the last couple of weeks, I'm not going to be too worried. I'll send it back to you, Maddie.
All right, Jared, thank you so much. I'll also quickly mention that yields up across the board as we're seeing a bit into equities this morning off the back of that print. But coming up, we're going to have more on the April payrolls report and a look at what sectors gained and lost the most jobs. That's coming up next on Yahoo Finance.
The April jobs report crossing this morning, showing 177,000 jobs added during the month of April. The unemployment rate staying steady at 4.2%, and average hourly earnings coming in just a little bit light of expectations. The growth there year over year, 3.8%. Our very own Alexandra Canal joins us now for a deeper dive into the numbers. Ali, let's start with some of the government jobs because that was one of the hot areas that, of course, everybody was looking at coming into this print.
Yeah, over the past few months, we've been continuing to track the impact of those DOGE layoffs within federal government. We saw that decline by 9,000 in April. We're down about 26,000 since January. We did see an uptick in state and local government jobs, so that was able to offset some of those federal losses, which is why we saw overall government add 10,000 jobs. Now, generally, federal workers are required to give 60 days notice before they are let go. So this suggests that we are likely to see federal layoffs ramp up significantly later this month. So future job reports, that's going to give us further clues about the pain that we could see here. Now, Oxford Economics is assuming about 200,000 federal job losses in 2025. Since January, we are at 26,000. So significantly more pain ahead. And that also includes about 75,000 workers who do ultimately end up accepting the administration's resignation offer. Now, another sector that I want to call out is healthcare. Continues to be one of the strongest sectors within this economy. We added 51,000 jobs in April. That's about the same as the average monthly gain that we've seen over the past 12 months. Within healthcare, we did see growth continue in hospitals along with ambulatory healthcare services. Another notable increase, though, is employment in transportation and warehousing. That increased by a whopping 29,000 in April, following little change the previous month. So a very significant rebound here. And just to note, the average over the past 12 months for this sector in particular has been about 12,000. So more than doubling that average in April. Those gains were concentrated in warehousing and storage, carriers and messengers, along with air transportation. So to me, my mind immediately goes to a lot of the front loading that we saw from these companies, that surge in imports to try and get away from these tariffs, circumvent them as much as possible. And then quick honorable mentions, we saw leisure and hospitality increase, construction jobs increase, and then for some of the biggest losers, retail trade declined by 2,000, whereas motor vehicle and parts decreased by 5,000.
All right, Ali, thank you so much for that overview. Really appreciate you breaking down the sector action for us. Let's take a look at the bond market. The 10-year Treasury yield rising after the stronger than expected April jobs print. 177,000 jobs added last month. Expectations were for 138,000. Unemployment holding steady at 4.2%. Joining us now with more, we've got Brian Relling. He's Wells Fargo's head of global fixed income strategy. Brian, great to speak with you. I also want to mention the president a couple minutes ago posting on Truth Social about gas prices going down, saying no inflation, the Fed should lower its rate. Will the Fed lower interest rates soon?
Well, not at the next meeting. I think we have to wait for kind of the hard data to come in that shows that the economy is slowing a little bit more. This jobs report's not going to do it. But I do think by the summer, I do expect the Fed to begin to cut rates. Just going to take a little bit more time.
And so would that be the beginning of aggressive cutting, or is that just something that is a one-off and see how it's ingested by the economy after seeing a trend of data that would actually lead them to that first cut of the year?
Yeah, I don't think it's going to be a flurry unless we're in a recession. That's not our expectation. I do think we'll get 2 or 3 cuts before the end of the year or into early next year. So moderate cutting, I would say. Really need to wait to see not only the jobs numbers, the employment market start to roll over a little bit more, which I think will come. Nothing drastic, but that will give them some support to cut. And also, I think they want to see those inflation numbers, make sure that the tariffs don't flow through and we start seeing a lot higher inflation. But as you mentioned, oil, gas prices coming down. So there are some positives on that front as well.
Well, it's interesting because we were speaking with Steve Sosnick over at Interactive Brokers earlier in the program, and he was saying that for the Fed to cut by this summer, we'd have to have recessionary economic pain happening in the data. But I hear you saying that you do expect those rate cuts to come and start by potentially this summer. How much economic pain do you anticipate coming to justify those kinds of cuts?
Well, I do expect we'll start to see, as the tariff impact shows up in the data, we'll start to see the employment market get a little worse. And, we'll be watching those inflation numbers really closely because I think the Fed would be comfortable going ahead and cutting rates if they're confident inflation is going to, not start to move higher again, as would be a concern with some of the tariffs. So, it's just going to take time to see that. Now, is it a guarantee they're going to cut? No. Obviously, if things roll over really hard, they will be cutting. But we're kind of looking for that soft landing, a window where the Fed can cut 2 or 3 times. Maybe it's not every meeting. Maybe it's every other meeting through kind of the late summer and fall.
We have 2 meetings until the lifting of the tariff pause, essentially. What does the Fed need to see in some of the tariff policy and clarity to emerge around negotiations and deals that may be starting to get netted out in order for them to feel more confident that there's not going to be as much of an impact on the inflationary side?
Well, I think it's going to be really difficult to feel super confident there until the data actually starts to come through. What we're seeing, of course, over the last couple of months is a lot of pull forward of imports and spending in anticipation of tariffs. As tariffs get implemented and to what extent, what's the impact on the economy, that's going to take time. That's going to be really where the challenge lies with the Fed, because the Fed obviously historically acts on a delay. They tend to be too late to making their moves. It's just the nature of how data comes in and that hard data being delayed from kind of real time. And so, balancing that is going to be kind of the key. So, a lot of the things that are happening would suggest, again, we're seeing the labor market, while still decent, softening, it would suggest that maybe the Fed should be lowering rates. But without the data, without support that inflation is not going to pick back up, the data, the Fed is really difficult for the Fed to move. So we're going to just have some more confidence on that inflation side before the Fed kind of starts to stick their toe in the water of rate cuts, I think.
I also want to talk to you about the bond market action here. We are starting to see traders sort of backing away from pricing in 4 interest rate cuts for the Federal Reserve by year end off the back of this stronger than anticipated jobs report. To what extent do you think that the bond market volatility that we saw right after those tariff announcements has started to wane? How do you anticipate the bond market acting in the next couple months?
Yeah, well, I'm really encouraged because, what we saw right after the tariffs was both equities going down and bonds going down, yields going up. So everybody was selling everything, and that's something you don't want to see. And what we've seen reemerge over the last week or two is that inverse relationship again, where look, today equities look like they're moving higher, and thus bonds move a little bit lower. Yields move up, and vice versa. When equity markets have a rougher day, you're seeing a little bit more support in the bond market. So we're kind of back to that more traditional inverse relationship between equities and bonds. And to me, that's a very positive, healthy thing. Hopefully we can kind of remain in that trend. When you start seeing them move together, especially selling everything, that's when things become more concerning.
All right, Brian, thanks so much for taking the time here. We're about 30 minutes out, just a little bit more from that, from the opening bell. Appreciate you taking the time.
Thanks.
That does it for our jobs report special. A quick check on markets across asset classes. Here we're taking a look at the U.S. major averages. First, we are higher across the board. We've seen a fractional move higher coming into this report, and now we're seeing this tick even higher for the Dow, the S&P 500, and the NASDAQ. 1% gains across the board for the major averages here. We're also taking a quick look at bonds here as the 5, 10, and 30-year are all moving in synchrony higher this morning. And then additionally, taking a look at currencies, specifically the dollar, as we're firing that up. It seems to be moving lower by about 0.4% here right now. We'll have much more on the jobs coverage ahead after the break.